Hey y'all, welcome back to Build Wealth Now News, or BWNN. We're going live right now because, well, the market's on fire, but not the good kind. I've got my ace analyst Sarah with me, who's not only a CFA, but also a chartered market technician. Sarah, thanks for jumping on this emergency stream.
Happy to be here, Billy Bob. And you're right, this isn't a drill. What we're seeing isn't just a dip. It's a confluence of macro forces that's sending shockwaves through equities, bonds, and even crypto.
All right, let's cut to the chase. The NASDAQ got hammered yesterday, even after NVIDIA dropped monster earnings. How does that happen?
Great question. NVIDIA reported $57 billion in revenue, beating expectations, and initially popped 5%. But then the music stopped. Traders started dumping. Why? Because the market's no longer pricing in endless AI-driven growth without scrutiny. Valuations across the Magnificent Seven have been stretched thin. And with the Fed signaling fewer rate cuts ahead, the free money era is over. Investors are taking profits and fast.
So is this the tech bubble finally bursting?
It might be the beginning of a reckoning. But what's really fascinating and frankly alarming is that this isn't just about tech. The real trigger may be coming from 6,000 miles away in Tokyo.
Tokyo? You mean Japan?
Exactly. Japan's 10-year government bond yield just hit its highest level since 2008, and their 40-year yield spiked to 3.7%, a record. Why? Because Prime Minister Sanae Takaichi just announced a $110 billion stimulus package, which the market interpreted not as growth fuel, but as a vote of no confidence in Japan's debt sustainability. Remember, Japan's debt is 250% of GDP.
Okay, but how does that hurt our stocks?
Through the yen carry trade, the biggest arbitrage trade in human history. For decades, investors borrowed cheap yen at near zero rates and invested that money in higher yielding assets like U.S. treasuries, tech stocks, even Bitcoin. But now, with Japanese yields rising, that trade is breaking down. Borrowing yen isn't cheap anymore, and Japanese investors are pulling money home. Reports say Japanese pension funds alone may be yanking $1.1 trillion out of U.S. treasuries.
A trillion?
Yes. And when the biggest buyers of U.S. debt become sellers, yields rise, liquidity tightens, and risk assets get crushed. That's why Bitcoin dropped another 5% last night, now down 28% from its peak. Tech stocks? Same story. They're priced for infinite cheap leverage, but that assumption just died.
Wow. So buying the dip ain't working no more?
Not right now. As veteran Marcus Padley put it, buying the dip has become a dangerous sport. We're in a regime shift. Correlations are breaking down, volatility spiking, the VIX just jumped to 26, and year-end positioning is amplifying the panic.
What should regular folks watching this do? Should they sell everything?
No panic moves, but it's time to get defensive. Reduce exposure to overvalued tech, check your portfolio's sensitivity to rising rates, and maybe hold more cash. This isn't 2008, but it could be the end of the post-COVID everything rally. Diversify into assets that benefit from a stronger yen or higher Japanese yields if you're sophisticated. For most investors, preserve capital. Wait for clarity.
Sarah, you always keep it real. Folks, if you like this breakdown, smash that like button, subscribe, and turn on notifications because this market's going to keep moving. Sarah, thanks for the truth bomb. Now let's us move on to a business fighting addiction. Indivior PLC, ticker INDV. That's the UK-listed pharma company fighting addiction with medications like Suboxone. Sarah, you did a deep dive on this one. What's the story?
Thanks, Billy Bob. Indivior is a fascinating case. It sits at the intersection of public health, litigation risk, and slow but steady profitability. First, what does Indivior do? It's almost entirely focused on medications for opioid use disorder, OUD, a chronic relapsing condition characterized by compulsive use of opioid drugs such as heroin, fentanyl, oxycodone, and other prescription painkillers. Its flagship product, Suboxone, buprenorphine, naloxone, accounts for the majority of revenue. They also have Sublocade, a monthly injectable, and RBP 6000, now branded as Sublocade, which gives them a long-acting option in a growing treatment market.
So, is this a moat business?
That's the $64,000 question. By Morningstar's framework, Indivior has a narrow moat, and it's potentially narrowing. Why? Two sources of advantage. Intangible assets. They hold patents and regulatory exclusivity tied to formulation and delivery mechanisms. Sublocade, for example, has FDA exclusivity through 2029. Switching costs. Once a patient is stabilized on Suboxone under medical supervision, switching carries clinical risk, so prescribers tend to stay put. But, and this is critical, generic competition on Suboxone has eroded pricing power. Suboxone film lost exclusivity years ago. That's why revenue has stagnated and why they're pushing hard on Sublocade and newer pipeline assets. Also, no network effects, no cost advantage, and they're not low-cost producers. So the moat is thin and fragile.
Got it. So what do the numbers say?
Let's go to the 2024 annual report and latest 10K equivalent. They're UK listed, so it's an annual report under IFRS. Market cap, approximately 1.9 billion pounds, 2.4 billion US dollars. Revenue, TTM, $844 million. Sales per share, approximately $3.50. EPS, diluted, approximately $0.28. 24.5%, it's solid for pharma. Net profit margin, 12.8%. Weighed down by legal expenses and R&D. On liquidity and leverage, current ratio 2.3. Quick ratio 1.9, total debt equity approximately 0.45. So they're not drowning in debt, and they've got strong short-term liquidity, which is crucial given their ongoing litigation over opioid marketing practices, a major execution risk.
Wait, litigation? I thought they settled that?
They've paid over $1.3 billion in settlements since 2019, including a $440 million DOJ settlement in 2023. But new suits keep emerging at the state level. That's why free cash flow is volatile. FCF per share was 42 cents last year, but could swing based on legal outlays.
So, should retail investors touch this?
Only with caution, and only as a small speculative position. The valuation looks cheap, trading at approximately 9 times forward PE. But that's a value trap if litigation escalates or Sublocade growth stalls. The opportunity lies in U.S. policy tailwinds. The current administration and SAM-HSA are pushing hard to expand OUD treatment access. If Indivior captures more of the long-acting injectable market, margins could re-rate. But the risk? One bad court ruling or a FDA delay in their pipeline like RBP 8770, their weekly injectable, could send the stock down 30% overnight.
So, not for the faint of heart.
Exactly. This isn't Apple or Microsoft. It's a phase 3 company, scaling profitability, but not yet stable. Investors need high risk tolerance and a 3 to 5 year horizon.
Appreciate that clarity, Sarah. Folks, if you're investing in INDV, do your homework and maybe don't bet the farm. Now back to that yen carry trade unraveling.
Thanks, Billy Bob. Stay safe out there, traders. The rug might be pulling, and it's coming from Tokyo.
BWNN is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. The business phase growth chart is taken from Stock Simplifier. Please note that investing carries its own risk, and you should do your own research before committing any stocks to your own portfolio. Until next time, this is Billy Bob signing off from Build Wealth Now News. Trade safe.